start with is looking at what's happening in the global grain market right now. This slide is characteristic of a little bit of information being a dangerous thing, I'm quite happy to say. It looks at the global supply and demand of total grains and essentially the world in its fifth year of consecutive surplus. There is a huge amount of detail sitting beneath this slide, both at the global level, but then more importantly, what's happening in the UK and how the UK is changing its relationship with the world wheat market specifically. And we're going to look at how that's happening and how that has been happening over the last 18 months or so. The structure of the talk really is into three broad areas. We'll start with the tour de force through the global areas. And looking at the sort of the global market, the challenge this year has been about, well, what kind of angle are we going to take this year? Because there's another surplus, and what does that mean? But I think there are some interesting changes in some of the long-term trends that we ought to be aware of across the different crops. I would suggest that there are, I would say, 5 key passive risks beneath the surface of the global grain market that we all really, really ought to be aware of as we're heading towards Brexit and beyond, because they will all, at some point, start to have an impact on how grain markets work in the UK. Those risks are not dissimilar to the passive risks that were building up 10 years ago, pre-financial crisis in 2007. There's a key analogy there. The catalyst for those risks coming to the surface will likely be weather at some point. We don't know when that will be, but we know that those risks are there, and those risks can align with each other to give us one hell of a lot of volatility, as we've been used to in the last 10 years, and I would suggest the recipe there is for stronger volatility as and when we get that weather catalyst at some point in the future. So a lot of the outlook isn't necessarily about this year, it's about understanding that those risks sit in the future and have ramifications for all parts of the industry. I'm going to bring us into the UK focus then and really talk about the detailed changes that are going on. And we've got this real chalk and cheese issue right now between wheat and barley, our two principal grains. We're going to talk about how that's come about and how farmers have had to respond to challenges in their rotation and the implications that had for supply of different grains in the UK. Finally, and in a bit of a warm-up for what Sarah's going to talk to you about later this morning, we've had a huge amount of demand to understand if and when we face tariffs, how would they precisely impact, or into the detail of how that would impact different crops, because there's a level of detail to go through. So we're taking a step into that. There's a huge amount of detail to explore after today around that, but let's crack on and start. So I want to start with some global perspectives, and I need to be really, really clear before we start getting into the detail, in that the UK grain market will still be heavily influenced by what's happening on the world stage. We might be changing our relationship with the world market. That's not necessarily a Brexit thing, but the global market will still have a huge bearing on what happens in the UK. So it's really important that we don't become inward-looking in our approach to what's happening in the UK, regardless of what's happening with domestic politics right now. I'm going to start talking about price a little bit now, and the chart here is just a summary of global export prices, and you see the spike there towards the top of the complex we saw earlier this year as it was becoming apparent that the world was having supply issues with high quality, primarily North American wheat coming to the market. As we've learned more, that concern has receded, but we still see quite a disparity in the grain price complex. I want to start sort of seeding the idea that the UK is changing its relationship with the world market. If I bring in now the UK feed wheat futures price, the benchmark value, of course, to us in the UK, and you can see that really over the course of the last 18 months, UK wheat has essentially moved from some of the cheapest wheat in the world to some of the most expensive on a like-for-like basis, largely driven by how the nature of the UK supply and demand has changed, the nature of the cropping, but also the nature of the demand as well. And that's had different inflationary impacts on wheat prices, and that's really important to bear in mind, because we can't look at the global dollar price, extrapolate a trend and expect to understand take that into the UK price context. So if we consider what's happened on the last 2 years, from September 15 to September 17, we can see that in dollar terms, Chicago wheat prices have fallen by around 10%. If I conduct the same analysis on UK feed wheat futures prices in pounds per tonne, we can see actually the exact opposite has happened, and indeed we've seen prices rise by 25%. and very similar levels if we were to look at the benchmark bread wheat price into the northwest of England. And so the inflationary forces in the UK market are very different to what we're seeing in the global market. So we can't really use the global market as a proxy to understand how prices have changed in the UK. To set the scene on where we are in terms of global wheat, and the chart here is just looking at headline wheat production from the USDA. We await keenly the next round of numbers coming out later this week. The green bars just show you how the global wheat forecasts have changed for the 17-18 crop, and that it's increased, although it still remains lower year on year. There's some real trends in here just to be aware of, though, and it's an amplification of the long-term trends, particularly in North America. The US wheat production down 25%, driven by both lower area, lower yield. Canadian production down 15%. Australian production down by a third, not because it's a bad year this year, but it's a correction from a really good year last year. And against those big declines, we've seen further rise in the likes of Russia. A 12% increase so far in the forecast for Russian wheat production, and we're going to look a little bit more detail in terms of what that means, not just for this year, but in terms of the longer-term makeup of the marketplace. The first risk I want to start putting on your horizon is the risk of deglobalization to the functioning of the global wheat market. If we look at this next chart, this chart is essentially analyzing how much of the global production in wheat and maize is traded. So essentially what we're saying here today is that around 25% of global wheat production has to be globally traded to get it from point of supply to point of demand, to basically allow the market to work. Any threat to deglobalization can therefore have quite a significant impact on the ability of the wheat market to function. And so if we enter into a period of deglobalization, that could cause some very real issues for price formation and functioning of the global marketplace. I'm just going to pause while I put this next slide up. This next slide is going to show you some very intriguing trends in global wheat stocks. The top line is essentially showing the headline global stocks-to-use ratio. The green line is essentially showing you the global stocks-to-use ratio exclusive of Chinese stocks. I'm just going to pause. I just want you to absorb and reflect what that means a little moment. So essentially what we're seeing is this real divergence essentially in headline global wheat stocks and then essentially accessible wheat stocks. There are two issues to consider. A lot of analysts are becoming increasingly skeptical actually of what other numbers in China actually look like. We've known that for a while. But also we know that any kind of issue with exportable wheat stocks around the world, the market's going to have an issue because it's very unlikely that those wheat stocks in China are going to find their way out to neutralize an issue. This is where a little bit of information becomes a dangerous thing. And from the outside, stocks-to-use ratio is over 30%. Well, we don't need to worry. But it's how accessible those stocks are, particularly to this next sort of segment of participants in the marketplace. This slide really is looking at essentially speculator positions in Chicago wheat. The blue element is long positions. The green element is short positions. The black line represents the net position of trade. And you can see for the first time really in 2 years, it's very neutral, largely because the shorts have reined in their position. I think largely on the realization about accessible stocks, but then also about then the huge consolidation we've seen this year in US wheat production as well. This is nothing new. It represents a risk. It's one area that will take the brunt of criticism and blame if, as and when we see prices rise, because it's an easy target. But addressing speculation is not a way of improving market activity. It's fixing the symptom, it's not fixing the cure, which is this is endemic erosion of transparency in the global wheat market. Just get back into some of the more core fundamentals, and this chart here will be quite familiar to many of you. This is just looking at the top 5 wheat exporters around the world for the last 3 years, and we've got to focus on Russia. 32 million tons export forecast for this season, way out in front and expected to be there for the season, really. That's a real challenge if we consider how the market's rebalancing itself from a supply point of view. We've used to seeing Europe up there as a big exporter, we've used to seeing the US up there, but Russia really is steaming ahead. We need to consider the performance of Russia on a long-term basis. So the chart here is looking at Russian wheat production really over the last 30 years or so. And if you consider really the last 5 years, and unfortunately the global grain market has a relatively short-term memory, we've seen consistent improvement in the size of the Russian wheat crop. And I put these lines on here because just to demonstrate the 5-year memory of the market that exists, and just really show that rolling 5-year minimum, that rolling 5-year maximum, and the market is growing in confidence about the consistency of supplies coming out of Russia. We need to consider what a 2012 event looks like. We need to consider what a 2010 event looks like. If that event was to occur today, the implication on the global market would be much bigger, just because of Russia's much bigger role in supplying wheat to the world. So it's an emerging issue. We know there's not an issue with the Russian wheat crop this year, but we know it's a continental climate. We know that over time it's not got the consistent climate to produce the stable yields that we're used to seeing in Western Europe. So it remains a very passive risk just to be aware of. In the current market situation, though, I believe some of the bearishness of the size of the Russian crop is being taken off by smaller US crop, but then also what's unfolding on Australia right now. Just to get your geography, the map at the bottom here in the purple area really demonstrates the main cropping areas in Australia. It's a big country, but cropping areas are quite consolidated. The map on the left-hand side is just giving you some visibility of rainfall, average rainfall in the first 3 months of the growing season. Let's just bring up September, because we're starting to see issues, particularly in the east. Relatively dry September. The first 10 days of October have really provided some relief in New South Wales. That state in particular produces around 30% of Russian wheat, of Australian wheat, and around 20% of barley. Already seeing a correction year on year because of the really good growing season last year as well. And there are stocks in the Australian system around an extra 3 million tonnes of wheat and about 500,000 tonnes of barley. So that will provide a level of relief. It's not one of those big years where we can start calling drought in Australia, but it's one of the elements in the marketplace, particularly on barley, I think, depending on how we get to the bottom of European barley quality through the next few months. Bring it into wheat and into the EU, and the EU is sort of on a bit of a rebound when it comes to wheat production, principally driven by what's happening in France. We remember last year France had what the UK had in 2012, which was pretty much a complete lack of summer, and the implications that that had on production. However, that's netted off to an extent where we see the issues impacting the Spanish crop. That will create internal export opportunities within the EU. As to whether it creates much opportunity for UK exports remains to be seen. We've got to get a handle on the quality a little bit more first as well. From an export point of view, we're not necessarily going to see a huge amount of increased action out of the EU, in my opinion. That's largely because of a Russian dominance thing, but also because of a currency thing. If we consider now that the euro, in some terms, is being seen as a bit of a safe haven, never thought I'd be saying that, but the fact is that in September, the euro was around 6% stronger against the dollar than it was in the previous September. That will likely hamper the ability of Europe to export competitively and be that sort of world-leading exporter that we've been used to in previous years. The chart here just helps you sort of map export progress so far, and although production is higher, it's unlikely that we'll see similar gains in exports. I want to move into sort of thinking about maize a little bit now and the mechanics of what's happening in the global maize market. And maize, as you know, is becoming more and more influential. It's that by far the dominant crop. We're talking not in millions of tons in terms of production, we're talking in billions of tons. And it's starting to dwarf the other crops. But what's driving that production, the blue line on this chart really shows you how the area has grown in recent years, and that's been a key force in driving production. But now, area of maize grown around the world is now plateauing. And so that means that's not a source of production growth. Production is being now grown pretty much by yield alone, and that opens up elements to future weather risk as well. Current situation is that we expect the US crop to be down by around 6% year on year, and the slow pace of harvest, around 2 weeks, is really having a near-term impact on availability. We're now starting to get visibility of what's happening in South America. We have the CONAB estimates and working on the basis that the Brazilian crop will be around 5% down year on year. Essentially is unlikely to replicate the conditions that we saw for the last growing season, but also because then the crops lost a little bit of area, or was expected to lose area to soybeans going forward. I think what's key to understand is just how those dynamics continue to change. And much like we've seen in wheat, we're seeing a movement away from US dominance, away from maize markets as well. If we look at production, it's still quite dominant, but it's losing some of that market share. If you consider about exports as well, because of the rise of the ethanol program over the last 10 years, dominance of exports have really been driven by what's happening in South America, to an extent Ukraine, but also in the margin, we see Russia stepping up into the maize market now, as well as in the wheat market. And that's a key thing to be aware of. You know, the Russian area up around about 8%. That's 8% from a low base, so it's not having a huge impact, but really it's a sign, and it's a side effect of Russia building that livestock industry to reduce that reliance on imported animal products. And that's going to be an interesting dynamic. Maize is becoming more interesting to me in terms of an analytical point of view, because we're starting to see early sensitivities coming back into the stocks-to-use ratio. We expect it to dip below 19%. Doesn't mean a huge amount this season, just means the market is vulnerable should we see any weather issues in following seasons. The slide here next is just for you to take away and just shows you on a 5-year basis, right up to 2022, just how the market shares are going to evolve over time on maize. The key thing with maize is to appreciate that there are very few producer exporters, and so you get an issue in one, it then has a ripple effect across the market and across the grain sector as a whole. And you can just start to see in the red area, I think, just how Russia's starting to sort of to carve out a little bit of a niche in exports, but mainly driven by domestic demand as well. The next point is something to be aware of, but it's not meaning to make light of the current geopolitical situation that's emerging in North Korea, but it has potential ramifications of what's happening essentially with North Korea. So the chart here just shows you just how much of the world maize trade goes into South Korea and Japan collectively. Yes, it's declining over time, but it's still nearly 20% of global maize trade going into those two economies. And we know that events can impact the market. I'm going to take you back 6.5 years, about March 2011, and the price chart here is Chicago maize futures. The circled area there is essentially when the Japanese earthquake and tsunami struck, and how you can just see how the grain markets reacted. A lot of speculation that coastal feed processing capacity was impacted, and actually that wasn't to be at the time. You can see just how that one event had huge influence over prices as well. It's not a certain risk. We don't know how things are going to pan out with the geopolitics, but it's one thing. It's scarily close to how the grain market works, with those big areas of import demand being South Korea and Japan. I'd like to focus a little bit now on thinking about barley. Barley, from a global point of view, we continue to see as something sort of waiting in the wings, very much a follower. The chart here really looking at production. It's kind of moving sideways if we consider it relative to what's happening, definitely with maize, but also to an extent with wheat as well. And the stocks to use. We can't really get too carried away with stocks to use because barley's main source of demand is in feed in the world context, and so it has to follow those price mechanisms. And as and when it has to, we'll lose demand into the other feed grains to make sure that. Thinking about barley imports for a while, and we're kind of in this sort of post-China period for a while. A few years ago, China was really raising through the ranks in terms of the amount of barley it was importing, largely driven by what was happening with policy, artificially high maize prices, and import restrictions on maize basically set up a loophole for barley to come into China, and that's all quite strong demand. China was then championing to be sort of top barley exporter around the world. Really challenging the position of overseas Saudi. policy changes meant that barley imports into China are sort of creeping away, but I think it's strategically very, very important to be able to have access to that Chinese barley market, because we know Chinese policy on grain tends to go in these quite big cycles, and so it's always good to have that infrastructure ready to go as and when we could be able to capitalise on it. From a European point of view, it's a bit the same, I suppose, from barley production, although we see some detailed changes. You know, a rebound in the French crop after recovering from really the devastating harvest of 2016, but then bigger issues in Spain as well. We expect to see an accumulation of barley stocks within Europe, and European barley becoming a little bit more of an internal affair, with exporters within Europe really hunting for that Spanish demand, and UK is pretty much in a good position. We'll look at the price chart that suggests that at the moment. And barley exports are a key thing for the UK grain industry to be driving. We still have a lot of uncertainty about malting barley in Europe at the moment. Scandinavian crops look good. French crops look better. I think a lot of the uncertainty is actually spiralling out of what's happening in the UK at the moment. I'm not entirely convinced that the European market's got a handle on the quality issues facing the UK malting barley crop right now. It's going to take a little bit of sifting through, and obviously uncertainties increased because we've still got standing crop, or we've still got crop in Scotland waiting to be harvested, and so that's going to have a bit of a challenge. So there's a lot of sifting through to be done to get a full picture of what's happening with malting barley quality across the board. Just to really illustrate sort of the price trends at the moment, the chart here looking at delivered feed grain prices into Rotterdam, and then the UK feed barley ex-farm price into euros. And you can see that clear discount there, that clear opportunity for UK feed barley exports to really capitalise on that Spanish demand, for instance. But competitiveness will matter within that mix as well. Just want to touch on what's happening in Canada quickly and take a sort of a multi-grain view there as well. The barley theme with Canada is on that long-term trend of consolidation, largely in a deregulated market. What we're seeing then is the rise of maize production, and wheat's holding its own largely on a yield basis in the long term. And so the Canadian grain industry is evolving over time as it adjusts to those different economic pressures. And we can see that in the long-term trend here. The chart here looks at the cumulative changes in Canadian crop area, and you can see the key grains, wheat, barley, and oats falling off. Some growth in maize, but a lot of that displacement is happening essentially with oilseeds, and Amandeep will touch on that in the next paper. I wanted to leave you in the global price, the global summary here, talking about the global price realities. I'll just draw your attention to those 5 key long-run risks that aren't necessarily flaring up this year, but strategically for the functioning of the global grain industry, for the UK grain industry, are there. That complacency towards supply, we see that coming in time and time again when we get this consistency in low-cost supplies, transparency, inaccessible stocks. Speculators in brackets, because that will be the target off of any fallout of price volatility, and that deglobalization, that relatively new threat that we're picking up on if we're entering into a deglobalized world. Want now really to focus on the second half of the presentation to really get into what's happening in the UK, and to start really focusing on how the UK S&D is shaping up. And I think it's a really exciting time for how UK statistics are going to evolve over time. We're in the process of recruiting a small team that's going to be driving UK S&D analysis on behalf of the industry and going forward. And so that's going to be a real great resource for the industry to use and drive the demands of the industry in terms of data, in terms of analysis that's required on the UK marketplace. Something that's been a long time in the making, but certainly something that will add a huge amount of value to the industry. So let's start with where we are with wheat. So the top left-hand chart there just gives us a view of availability, and I know a number of you in the room were slightly stunned by the size of the crop number that came out provisionally from DEFRA. I know certainly from a professional opinion, it did surprise myself, but you kind of go along with the statistics and what they're telling you. I think a lot of the issue is the availability picture of UK wheat this year is not just about production. And it's not just about imports. A lot of it lies in the big change we see in opening stocks as well, of essentially 1 million tonne down in opening stocks year on year. If you remember a year ago, we carried over those big stocks, and it was those stocks that drove the autumn export campaign in 16, 17. It wasn't really a new crop issue. Now we've got the complete opposite issue there as well. So in essence, what I'm saying is that the decline in opening stocks has more than offset the fact that the stats are telling us that there's a higher crop number out there this year. We've got to see how imports pan out. It's one of those challenging years that we kind of have to feel as much information as possible to get a handle on imports. From a demand point of view, relatively static. From an H&I point of view, increased demand coming in form of feed, although there's an inroad into the demand into the poultry sector. Low cost or relatively competitive barley and maize will probably be displacing some feed demand that wheat currently has at the moment. So essentially we've got a balance which is down around about 500,000 tonnes, and we can see what that means for sort of how we can start to see how knife edge the UK wheat S&D is becoming as a matter of course. And that's really important. This is a long-term thing. You know, the UK is no longer assumed to be a net exporter of wheat, primarily in my mind driven by the fact that over the last 10 years the UK wheat area has fallen by 10% as farmers have sought to find new ways to manage key weeds, really moving towards more spring cropping is an integrated crop management approach. That means that any kind of shocks to the system can easily shift the UK S&D into an export situation or an import situation and give that domestic change in prices even before we consider the global picture. One of the key issues is, of course, what's happening with quality. Here are the traditional diagrams that you'll be used to in terms of understanding where we are on cereal quality survey. And the charts here are looking at the full spec pass rates. So on the left-hand diagram, it's that center number, that 45% of Group 1 samples met the spec in 2016. If we know now in the second provisional that number for 2017 has fallen to 24% and will likely fall further as we get new information coming forward. That's sort of sparked milling premiums to rise to the highest levels in over a year. But I think it's really important to understand the nature of the quality from year to year. This is a Hagberg-led issue primarily. Traditionally, in the last few years, we've been used to more protein-led issues, and that creates different challenges for the supply chain to deal with those issues as well. Also, there's an issue of consistency. I think it's really what we're starting to continue to see in the milling industry. It's about the consistency of the quality that matters, as well as the underlying quality as well. If we're doing industrial baking processes, last thing the miller needs is to see a wave or up and down in terms of that quality consistency. And that's a real threat to giving demand away to imports, because we know just the nature of how imports work. They can provide a consistent supply of quality on a big scale to the importer and consumer, and something that's a real challenge to lay down to the domestic industry is how is the industry going to mimic that consistency and quality that is available from imported grains. However, there is a level of resilience if we look at bread wheat in the UK, because what we've seen, because of the rise of new varieties, providing competitive yields, but also providing more of a rounded agronomic package for farmers. We know that disease resistance is becoming more important in helping farmers with their integrated crop management. That has enabled farmers to essentially grow a greater share of Group 1 and 2 bread wheat type varieties. The chart here really converts data from the planting survey, which looks at the market shares of the different NABIM groups, and a quality survey to give us an indicative idea of how much of the crop area is meeting spec. So we've gone for a medium bread spec here. And we can see that currently at the moment, although pass rates for 2017 in the provisional were lower, that at the moment the pass rate is comparable with the final data of 2016 because of the higher area of the Group 1 and 2s is offering a bit of resilience. We know that will likely fall away though as we get into the final CQS data coming forward. The skeptics of you, I've put in 2012 their pass rate if you're really skeptical about UK quality, but I don't think we're anywhere near that. And bear in mind, 2012 quality was a bushel weight led issue, not a Hagberg led issue that we're seeing this season. I think the big area of concern for me when I look at the wheat market is what's happened to Group 3s, although I do believe there's probably light at the end of the tunnel. Group 3s have kind of been a bit of a pet subject for me over the last few months, particularly in the context of Brexit. We know that there's demand there domestically into the biscuit manufacturing and wider flour applications, but also because if you ever wanted to find a niche, anything that looks like a niche opportunity to export in grain, soft wheat is where the UK needs to look. Our biggest problem is that we are growing very, very little soft wheat in our arable rotations. So we're caught in a bit of a paradox here at the moment, folks, on Group 3s, and I think there's a real opportunity to have a debate as to what are the barriers getting in the way of that. So what we're seeing is around 5% now of the wheat area is being grown to Group 3s, and the whammy this year is that the quality of the spec needed shown on the markets has fallen away quite quickly this year relative to last year. I would expect that pass rate to fall a little bit lower again as we get the final data into the cereal quality survey. However, going back, James Webster, one of our analysts here today, drove a lot of our gross margins work looking at how Group 3s could perform in 2018 gross margins, and actually it looks quite favourable. So I think the economic signals are there for farmers to grow more Group 3s. And we've started to see it. The chart here just looks at the regional share of Group 3s. So we did start to see a bit of a kick up in market share in 2017. I would expect that to be carried on for 2018 harvest. I think the biggest constraint will be availability of commercial seed, because speaking to a few seed houses, it's one of the key things they sold out of first was Group 3 seed. So I think there's opportunity there. What we have to see is the Group 3 varieties going through the same revolution as we've seen with the 1s and 2s, not just about yield, but about that rounded, integrated solution for farmers. Probably the one weakness there is probably on disease as well. So it's an exciting area. And because we've got so many issues going on, or developments going on with milling wheat, it's great to be able to tell you that AHDB is bringing back with NABIM the Milling Wheat Conference, I think coming back on the 1st of March up in Cambridge, and I think there's a real opportunity to kind of get the milling wheat supply chain together and really discuss what is quite an exciting time, I think, for the supply chain, and how we can add value and how we can improve efficiency within the chain. We kind of now need to start thinking about what Brexit means for the different crops. And wheat particularly is complex because we can't treat wheat as wheat. And if you will, visualize, I suppose, a revolving door of wheat coming in and out of the UK and into the EU. And the chart here just gives you an overview of UK wheat trade with the rest of the world. So the blue bar is imports, the green bar is exports, the black line is essentially the cumulative trade. So there's two things to bear in mind is, at any one time, we're generally importing and we're exporting, because that essentially comes down to different grades of wheat coming in and out. And also, just look how unpredictable it is to call whether the UK, at the beginning of any one season, we've got 1, 2, 3, 4 seasons there, how unpredictable it is to be able to call whether the UK is going to be a net importer or a net exporter. This is here to stay, this concept, the expectation that the UK is a net exporter of wheat. By default, we should be discarding that as thoughts, and so we've got to think smart about how we manage that as well. So it's complicated. We'll come back to this in a minute. I just want to touch on barley first as well. Barley's, from a UK point of view, we're still producing a big barley crop. We know that more farmers are planting, having to use more spring barley for their cultural control, to dealing with grass weeds. And so that's creating quite a high availability. Demand, we should be quite well supported. But we're getting close to securing 4 million tonnes of feed demand for barley on price. I think there's a real opportunity with this disparity in wheat and barley prices for the ruminant feed industry to take a real advantage over what are competitive barley prices relative to wheat. We know that the nutritional constraints of using barley in monogastrics is there, so there's a real opportunity to integrate more with the ruminant sector, particularly into dairy, and particularly get high-value feed rations developed out of what is a plentiful resource of barley. This is where we mirror what's happening in wheat, because we know we can start to see this big surplus of barley continuing. Now, from a balance point of view, year on year, the barley balance is up by around 17%, whereas at the same time, the wheat balance is down by 14%. This is the chalk and cheese elements. From a trade point of view, we saw the complexities of wheat, Barley is actually much more simpler to analyze. This is the same chart for barley. It's a very one-sided affair as to how the UK trades barley, and it's dominated by exports. That makes the UK, makes barley for the UK in a Brexit kind of way probably one of the biggest challenges we have, because there's not really opportunity to import substitute because we're not really importing anything to substitute. Currency is going to have a big part to play within that as well. I'm going to leave that there and to take away. I think that the expectation that the pound was going to be at parity with the euro by Christmas or early 2018, kind of, we have to probably dismiss that now. The expectation of the raises to interest rates kind of kiboshes any hope of getting of seeing further appreciation against the euro for now. I think what's interesting is that relationship with the dollar. If the UK is going to reduce its exposure to the EU market and drive more world markets, the value of the pound against the dollar becomes much more important. And we've really seen that divergence. We've seen some rebuilding strength against the dollar. And you could argue it's not all just about pound weakness. It's about what's happening in the US. And there's a few issues going on there with politics or something at the moment. What we have to do is then sort of start to get a little bit knee-deep in treacle and sort of understand, well, what do tariffs mean to the UK? What could tariffs mean? This is not suggesting that we will be facing by tariffs, but it's a very real scenario we've got to try and play with. This is what we left with you last year, was just a summary of the tariffs that currently work for third countries trying to access the EU marketplace. It's very, very likely that the UK could well become a third country trying to access the EU marketplace. That's how I sort of put it in my own simple terms. The bottom right-hand table is really important because that tells us the level of free market access that Ukraine has to the EU market. That continues to grow, part of the solidarity for the EU in light of what's happened in Crimea back in 2014. That's an important dynamic because it's likely, not only can Ukraine produce grain cheaper than the UK, it's likely that Ukraine will have more preferential access to the EU market than the UK. So there's a bit of a double whammy there where we have surpluses to move into the EU marketplace. So what does all this mean? So really getting you into sort of warming up for this, I've taken a little bit of a leap into trying to figure out how we could extrapolate this into what it means for specific commodities in the UK. First of all, we have to caveat this to the hilt. There's a huge number of caveats that are listed in there. We're going to pop this up on the website by the end of the week as well because it's quite a complex analysis, and I've got 10 minutes left. So we're going to just sort of gently walk through this. This is a relatively new area for the industry to understand how these things work. There are crop-by-crop impacts, as well as sort of the macro sector aspects that Sarah's going to really touch on a bit later on. So let me just sort of walk you through. Now, it's important to remember that tariffs don't always apply. They only really matter when you have to trade something. So the blue dotted line here represents the domestic marketplace. The horizontal lines basically represent the different levels of the global marketplace. So when we have something in surplus, the market falls, and it has to fall to compete with the global or European market to drive exports. If suddenly we're faced with the imposition of the tariff on our exports into the EU market, the market has to work that extra bit harder to achieve the same level of business. On the flip side, on imports, if the domestic market will rise to attracting imports to fill the supply gap, but then if there are reciprocal tariffs in place, and this would be the impact on that as well, the market would have to work harder, assuming that there would be reciprocal tariffs in place. Essentially, because we've seen wheat isn't wheat, for instance, we've got some different, we're always trading different grades of wheat there as well. And so at any one time, we could be exporting a grade of wheat and importing a grade of wheat. So these markets are operating in isolation. It's quite diverse as well. So any two scenarios can be happening at any one time. Those are the scenarios we've kind of just put in. We've used James Webster's gross margins forecast for 2018 that were done early in the summer. And we can start to analyze how those impacts have panned out. So we start with the status quo gross margins, and we start to then build up, okay, well, what are the crops then that we're heavily export reliant on to bring through? And we start to bring in, this is where we bring in the feed barleys, because we know we've got a huge amount of barley to export. And that's the first crop that starts to see the gross margin impact, because it's faced with a tariff into the EU market, and it's likely to be faced with that tariff for a considerable time of the trading season. We start to bring in sort of where we're more of a mild exporter, and we start to see some more of the grain commodities coming through. So some of our wheat's coming into the mix in there as well. Where we're more marginal importers, this is where we start to bring in the oats. Oats are really, really complicated because we don't have a tariff rate quota on oats. The EU doesn't, and so the analysis here is done on the basis of the cliff edge tariff. In reality, that probably wouldn't happen because you'd probably stimulate domestic feed demand for oats before exports became economically viable. We can then start to think about, from when we're starting on the import side of things, again, assuming that we've got those reciprocal tariffs in place, and that starts to build in. The thing I'm going to sort of highlight, I'm going to bring all these up now. That third column in bread wheat is a huge category. We know even in that category of bread wheat, there are several different grades that exist. The limitations of this is we don't have visibility of what those different grades are, what the volumes are, and everything else that goes with it. So depending on where that grade is, where the quality is, represents the different aspects. Just going to put quickly up the oat situation in terms of trade. Oats is a bit like wheat in that we can't really call whether we're going to be a net exporter or a net importer. And as such, and given the complexities, Helen Plant, one of our senior analysts, is working on a special piece of analysis for oats on Brexit to really get our heads around what it means for the industry, because there's also an Irish border issue to consider as well with oats, quite specifically. And so that is a real challenging sector to think about. That's the beginnings of starting to think about how tariffs could impact things. One of the key things are, we're on a journey towards Brexit. The crop going in the ground now faces a marketing period which will partly occur in a post-Brexit world if we go along with the current timelines. The resilience of the industry to Brexit in the short term will largely depend on prices, and we're starting to see, we've got good visibility of the forward prices. Essentially, the NOV18 price there we can see evolving is stronger than it's been in reasonable years, but if we look back further than that, it certainly isn't setting any record levels. And so the price will play a huge role in determining how quickly we see the impact of Brexit on the industry right now. One of the key other areas to think about is how different types of tariffs will be implemented. At the moment, we have, from an EU point of view, we have variable rate tariffs in place, primarily on high quality milling wheat and also on maize as well. They haven't largely been in play for many years, more importantly coming into play in the last few months, particularly on maize. And the question is how, if the UK will replicate these to emulate what's already happening in the European marketplace. I appreciate there's a huge amount of analysis that's just come out that way. I think the key thing is really to sum up the threats and opportunities. I think from an opportunities point of view, I think there is that opportunity for import substitution, not necessarily on grain directly, because we know farmers will always find weather conditions challenging to hit the precise spec that the consumers need. But I think we have to think about the sector in the broader terms of agri-food, and how are we going to add value to our surpluses? Do we want to continue slogging our guts out to try and be a commodity producer, high volume, low value exports, or can we use surpluses more smarter to integrate more with our livestock industries, more with our food processing industries to actually create higher value? To me, a post-Brexit world looks like high value, looks like a value game rather than a volume game, because we know that it's going to be really challenging for us to do that as well. The key opportunity for me, as I see it, is probably the opportunity to redefine our agri-food systems and create one of the most sustainable food industries in the world. That's not ideology, that's a necessity, as I see it, for the industry to survive there as well. And the challenges there are there for you to consider. I leave you with the final slide. I was heavily involved in writing the report on the left-hand side, and I have to admit that was a very, very difficult thing to write, as much as a lot of people tell you it's a difficult thing to read, because it's asking some very, very challenging question to the industry. And I believe we're in the phase of basically no idea is a bad idea right now. And Chairman, I think that's where I'm going to leave it.